This video is for educational purposes only and should not be considered financial advice. The magic of SMT divergence with the 4 EMA. Have you had the unfortunate experience of measuring out a trade, locating liquidity and fair value gaps on higher time frames, seeing your perfect setup happen on a lower time frame, and taking an entry only to have price stop you out, then go straight to your target? This can happen because many times the algorithm is holding one asset in lieu of another, and this can be very frustrating when you know there is a liquidity or rebalancing target that is the most likely area for price to go to. The best way to overcome this scenario is to watch the dollar chart as well as the other assets that correspond to the asset you are trying to trade. This is what ICT calls SMT divergence, or smart money technique divergence. When, for instance, the NASDAQ 100 makes a lower low and the SPX 500 makes a higher low. ICT's SMT divergence can be really helpful in knowing which asset to trade during your chosen time frame. And by adding the 4 EMA with a shift of 4, you will be able to tell which asset is the one that is going to move freely. This will increase your win rate considerably, especially on those days when price is consolidating. Let's take a look at a few examples. Example 1. Here we have the dollar, the SPX 500, and the NASDAQ 100. If we look on the dollar chart, we can see price has gone below the 4 EMA and then is making an attempt to come back up. And this is timed at 17:05, which is 10:05 Eastern Standard Time. This is during the New York session. If we look here over at the SPX 500, price crossed below the 4 EMA at 17:05. And if we see the NASDAQ 100 at 17:05, price also crosses below the 4 EMA at 17:05. But here is where you have to pay attention and choose the asset that is moving more clearly in your direction. Let's take a look at NASDAQ. We see there was a break of structure right here, but it wasn't that convincing. However, it's still there. Then it moves back into 50% of the impulse leg. And then it comes below the 4 EMA, which is definitely an entry signal. However, this is a lot cleaner on the SPX 500. There is a clear break of structure. Price comes right back into 50% of the impulse leg and then closes below the 4 EMA. Seeing this, you have more confidence that price is going to move to the downside, and it does. And you have a very large move with not that much retracement, as opposed to the NASDAQ 100, where your move comes down, but then it's giving you more of an action that it's heading back up. And it's a lot closer to the 4 EMA, where this price action is a lot farther from the 4 EMA. The SPX 500 is the better trade, especially when you see all of this price action moving back and forth in a lot of wicks. You would have more confidence entering your trade here than you would entering your trade here. And the dollar, of course, moves up and then breaks above the 4 EMA with a shift of 4. And that would definitely give you confidence that you're on the right side of the trade. Let's take a look at example 2. Here we have dollar moving to the upside. However, there's a lot of up and down price action with a lot of wicks. If we look at the SPX 500, we can see there's a break of structure and then a retracement, but it does not close below the 4 EMA. Then it closes above the 4 EMA, and that is your entry. price does come back against you, but it does not come below this area or this area. And you could either have your stop here or your stop loss here. Then price moves to the upside and takes out liquidity over here, but also moves up to the 500 EMA. If we look at the NASDAQ chart, we can see that price moved to the downside. There was a break of structure. Then price retraced back into this order block and then closed above the 4 EMA. You would enter there, but price does come back against you and almost comes against your stop. Now, if you had your stop loss here, you definitely would have been stopped out. This is what we were talking about in our opening when we talked about measuring the chart and seeing the setup perfectly, placing your entry, but only to get stopped out. That's what happens a lot when price is holding one asset, which is the NASDAQ here, and then moving the other asset, which is the SPX 500. You see the SPX moves a lot cleaner than the NASDAQ does. There was a lot more wick action going on with the NASDAQ. And this is the point where the NASDAQ comes down below the 4 EMA, but it does not come down below the 4 EMA on the SPX 500. This is that candle here, closing below the 4 EMA. And this is that candle that does not close below the 4 EMA. Now, one interesting aspect of this trade, if we look at a 4-hour, this is a 5-minute chart. If we look at a 4-hour chart on the NASDAQ, this is when that trade occurred. And if you can see, price touched the 200 EMA at this point. Now, you are definitely in a downtrend. And to take a buy during a downtrend is very brave and courageous. However, if you've been trading for a while, you know that price does have a reaction off of the 200 EMA. And that is on a 4-hour chart. Price touches the 200 EMA and then comes all the way back up here to take this liquidity. So going back to the other chart, we can see price touched the 200 EMA on the 4-hour time frame right here, and then comes back up to take this liquidity over here. That's why it's important to be looking on multiple time frames to see how your trade is playing out and what are the factors that could affect your trade. You would also have the foresight to understand that this should not be a long-term trade for you. You should be able to get out of this trade pretty quickly because you are in a downtrend. So your best bet is to probably shoot for this 200 EMA if you're on the NASDAQ, and probably to shoot for this 500 EMA if you're on the SPX 500. So to recap, look at the foundational currency, whether it's the dollar or the yen or another currency, to see its strength. Is it consolidating or trending? Look at two corresponding currencies to see which one is moving faster and staying above or below the 4 EMA. Then look on your higher time frames for your EMA correlation. That will give you your confidence and also help you to know whether you should stay in that trade or close it early. We hope you've enjoyed watching this video. Please like and subscribe for more videos like these. Thank you for watching.